Hey guys, it's MH In today's video, we're going over one of the most interesting phenomenons in finance, short squeezes. I'm sure you heard of this term before, but you might not fully understand what it means or how it occurs. A short squeeze is a situation where a heavily shorted stock all of a sudden moves sharply higher, forcing short sellers or those betting that the stock will go down to close their positions. By doing so, these short sellers actually add to the upward pressure on the stock and cause it to skyrocket. Think of a short squeeze like double bouncing someone on a trampoline. To fully comprehend this concept, you first have to understand how short selling works. Also commonly known as shorting, selling short, or going short selling is a way of making money when a stock goes down. To be short is to imply one is bearish on a particular stock and suggest that you can expect the price of a stock to decline. The way you actually bet that a stock goes down is more complicated than you think. To open a short position on a stock, a short seller, aka you, will borrow the shares. This may sound crazy at first, but just bear with me as we continue to explain. In order for someone betting that a stock will go down to actually profit from such a situation, he or she will borrow the shares from their broker. One must have a margin account in order to do this, as the broker will charge interest on the value of the borrowed shares while the position is open. To close the short position, a trader buys the shares back from the market and then returns them to the broker/lender. So just to help you conceptualize this, let's imagine you have a trader who believes Intel, a stock which is trading at $50, will decline in price. In order to short the stock, he borrows 100 shares from his broker and then sells these shares immediately on the open market for $50, promising to repay the broker in the shares he borrowed. After selling the shares on the open market immediately, he's now holding $5,000 in cash. In real life, all this happens behind the scenes. Shorting a stock is simply a click of a button on a screen, but the mechanics behind it is what you need to understand going forward. Okay, so now the trader is short 100 shares since he sold something that he actually doesn't own. While he's short, the broker is charging him interest on the borrowed shares. So a week passes, and Intel reports earnings which show that the company missed their marks significantly. This causes the stock to fall to $40. The trader now decides to close the short, so he proceeds to buy 100 shares for $40 on the open market to replace the borrowed shares. Remember, once again, in real life, he's just clicking a button on a screen that basically says, close the short. But behind the scenes, it's important to note what is happening. So he buys 100 shares on the open market, which are now trading at $40, costing him a total of $4,000. He then gives those shares back to the broker, keeping the leftover. His profits now total $1,000. $50, the initial price he paid, minus $40, the price for which he sold, times 100. So you may be asking yourself, okay, who's losing in this situation? Well, shorting is actually a calculated action. In this situation, the trader makes money and the broker loses money as it took back shares which cost less than what they were going for when they were initially loaned out. But this isn't a massive problem to them because most of the time, brokers are simply agents who are finding shares held by investors who are long that particular stock. The broker finds someone to lend the share to the trader who is shorting the stock. This is usually someone who is long in the stock and cares little about the short-term performance of the asset. So in turn, the money they lost isn't realized, and most of the time, the stock is able to recover, costing the broker little to no money in the grand scheme of things, because they have the system all worked out. Between the money they had gained on commissions and the interest they charge for shorting, they essentially never really lose. Now let's pretend that same trader decided to be greedy and not sell when the company's stock dipped to $40. He leaves the position open expecting a further decline in price. However, a competitor swoops in and unexpectedly acquires the company with a takeover bid of $70 per share. If the trader now decides to close the short position at $70, he would now be forced to purchase the stock on the open market for $70, meaning he had to buy shares at a significantly higher price than when he's resigning to cover his position. In simple terms, that $70 which it costs now per share, minus $50, which is what he sold for, times 100. In this situation, the trader loses $2,000 on top of interest and commission costs. And remember, when a trader goes short on a stock, the losses are technically unlimited, as the stock could in theory go up to an infinite amount. This is why many brokers will require you to save some cash as collateral just in case your position goes haywire. And it's also why you will be margin called, forcing you to close your position after a certain amount of losses so they can ensure they get their borrowed stock back. Okay, so how does this have anything to do with a short squeeze? Well, a short squeeze occurs when a stock that is very actively shorted begins to rise. This rise is accelerated by the incoming squeeze, which, as I will explain, feeds into an incredible rise in the stock's price. Remember how I said short sellers need margin accounts to trade? Well, a short squeeze occurs when short sellers are forced to cover their trades and begin buying back their short positions because of margin requirements and significant losses. So let's say company X is trading for $10 and everyone and their mother believes it's doomed for failure. Company X is heavily shorted because of this. But now let's say for some reason the stock's price of a company X begins to rise unexpectedly. Short sellers now begin to take on losses, and like I mentioned earlier, if the losses get large enough, they begin to buy back shares in order to close their positions. This can be for a number of reasons, but it's usually because they are margin called or they simply want to avoid further losses. This buying can turn into a feedback loop where demand for the shares attract more buyers, which pushes the stock even higher, which causes more and more short sellers to buy back and cover their positions. The results of this can be pretty spectacular. For an example, in October of 2008, Volkswagen became briefly the most valuable company in the world during an epic short squeeze. A crazy situation and a perfect storm of variables caused a short squeeze which drove the price of the stock from the low 200s to over $1,000, a 500% return in just one day. Predicting these sorts of moves is quite difficult, as the requirement is a very special case of circumstances. There are contrarian investors who seek out stocks which are heavily shorted and go long on them hoping for a jump in price. If you do seek this strategy, please consider Robinhood, a commission-free trading application that could net you a free $200 stock just for signing up with my affiliate code, which is found in the description of this video. Short selling is quite an interesting topic, which inspires phenomena such as short squeezes. Thank you guys for watching. Be on the lookout for my next video where we dive into one of the greatest short seller stories in trading history. Don't forget to subscribe and like if you enjoyed, and of course, drop a comment and let me know what you think about my latest content.